anyone coming into new deals and new offerings are coming into a really great buying period. Looking at the next 10 years, we're still going to have the same good asset price growth. So I think it's a great time to get in.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. We're so glad you're here with us today. I've got another amazing guest, Casey Stratton. Casey, welcome to the show.
Hey, morning, Jeremy. Thanks for having me.
Yeah, I'm looking forward to chopping it up here with you this morning. We've had the pleasure of connecting on a couple of different occasions now, so appreciate your willingness to provide our listening audience with some value today. For our listeners, Casey is a seasoned investor with over a decade of expertise in real estate investing and has been a general partner on over $200 million in total deal transactions. Today, Casey primarily focuses on bringing passive real estate investment opportunities to high-earning professionals who are also looking to accelerate their financial goals. Casey, I would say that the majority of those that listen to our podcast probably fit into that category of being, somewhat relatively high-earning professionals. Maybe they've got, the achievement itch or want to scratch it, or maybe they want to look to, into alternative investments or entrepreneurship in general. So maybe you can kind of give our listening audience a little bit more of your story, your journey, what you're focused on today, et cetera.
Yeah, absolutely. Well, glad to hear I'm in the right place. I started off my big investing push about 10 years ago. I had my first job in a tech space and went through a job layoff and, pretty high unemployment at the time. So it took me about 6 months to land on my feet on the next job. And it really left a bitter taste in my mouth where I didn't want to be so dependent on, a corporate job again. And I just started researching online, didn't know exactly what I was trying to find, but I learned about this whole financial independence movement. And it really spoke to me about what does it look like to try and invest and build a net worth that allows you the passive income to have more options in life and decide different career paths or just how you want to spend your time without having to go in 9 to 5 every day. And so my wife and I really dove in hard to that about 10 years ago. And it's been a really interesting journey where I didn't end up where I thought I would, but it's just been pretty amazing. And pretty early on, I wanted to find ways to try and accelerate that journey to my goals and my net worth number. And I found real estate, and my background's in finance. So looking at some deals, it just made a lot of sense. You get some cash flow, build your net worth up. And so I dove into that and have really believed that it's a cornerstone that everyone should have in their portfolio if they want to quickly and accelerate that journey to financial independence.
Yeah, it makes total sense. And, being a guy that's a recovering technology sales guy, I totally understand, the space that you came out of, really a decade ago, maybe on kind of the backside of the global financial crisis, which for me personally, that was also a good time for me to get involved, on the active side of single family home ownership. So appreciate that. Would love for you to tell our listening audience a little bit more about kind of what were some of those maybe baby steps or initial decisions that you made, 10 years ago, as you kind of, launched your journey into real estate investing.
Yeah. Well, I think I have the blessing and maybe a curse of maybe misplaced confidence or not, understand where the landmines are before I go in there. But I started looking at what investing in a duplex would look like. And my wife and I had recently moved back to our hometown in Washington State. And I was looking at some of these opportunities, and I ran the numbers. And my wife was pregnant with our first son at the time, and we needed to find a place to live. So I was able to quickly pull the trigger on the duplex and found that we could live on one side and have the rent cover the mortgage. And that just made so much sense to me. I was hooked, started buying a couple others, but then that kind of grew. I found some partners. We got into some commercial real estate, some retail, and some new development. And eventually I found larger scale multifamily where you can actually force appreciation on those assets was really what made the most sense to me. I liked that it was a little bit more scientific than buying single family and being subject to the whims of the real estate market. You can have a plan to improve rents and value. So about 5 years, I dove into that full time and started raising capital from other investors to participate in larger deals that we couldn't buy ourselves.
That's great. I've got a lot of horror stories to tell about related to my days back in single family fix and flips, right? Anything from, acquiring properties that have, stripper poles to marijuana farms to, a lot of crazy things going on in these houses, right? So, just out of curiosity, would love to know if you've got a special story that you remember from the past, kind of those early days as you're, house hacking or acquiring single family properties.
I started off on my first couple duplexes wanting to make sure that they were a financial success. And to me, that meant self managing to try and improve cash flow. Later on, I got smarter and realized I need to lean on partnerships and leverage people who are better and smarter than I am in certain areas. But when I was self managing, I mean, you're talking about getting very intimate into people's lives because you go into their houses. Um, I had one duplex where I did not properly screen tenants and I didn't properly enforce rules that I knew I probably should be. And this one tenant, she was just a complete slob and food left out everywhere. Laundry never got put away. I mean, you name it, it was out there. And they started complaining to me that, hey, there's mice in your duplex. I'm like, okay, well, let's get a pest control guy out there. Another time she was like, yeah, your dishwasher's broken. And I go in there and I open it up and it's just like standing water and black mold all around it. I'm like, how long has this been broken? She's like, oh, yeah, like a month. Turns out that I had a garbage disposal and she never used it. So it just got clogged up and wouldn't drain. I eventually got her out of there. And then, of course, all the pests were like, well, where'd all our food go? So then they moved over to the other tenant side. After that, I'm just like, I really need to get some professional management here. And once I did that and it freed up my time to focus more on evaluating new deals, I started scaling more. It's like, this just makes so much more sense to put the right people in the right seats.
Yeah, I appreciate you sharing that. We sometimes have individuals that are, on the show. They listen to the show regularly. It's investors that I talk to, throughout the course of the week and months, that really want to reconcile, do I become or remain an active real estate investor in single family, small multifamily, some other asset class, or do I just instead deploy that capital into another operator's deal where that operator is a gold standard, best in class operator in the space today, right? That already has a team assembled, that already has a great track record, that already knows what it takes to successfully, transact, small to medium sized apartment communities, from kind of acquisition through disposition. So, what type of feedback maybe would you give to that individual that's kind of on the fence? They're not sure if they should be an active real estate investor or if instead they should just focus on their occupation and their family and leave it up to the experts.
Yeah, I think that there's no right or wrong answer, and I'd want to know like what their life situation is. If you are interested and you really actually want to learn about how this investing works and the strategies and get immersed in it, maybe starting in some smaller multifamily is a great idea, like I did. Right? There's a lot of strategies like live in, fix and flips. You can live in a duplex and fix it up and burr it. Um, Once you start getting into larger commercial properties, you start needing to really have a good network to find the right deals. You need to have the resume. Lenders look at your past experience. What's your schedule of real estate owned? Do you have the net worth to back these loans if you're going recourse? And there's a lot more spaces to stub your toes on. What I've found is, especially with these deals, when you get the experienced operators, they have both the network to get the best deals and know how to negotiate it, and also the right investment strategies to provide the superior returns that most retail investors can't get themselves. Additionally, a lot of my investors I work with, they're high paid professionals or they're CEOs of their own company, and their time is much more effectively placed in maximizing their earnings, progressing their careers, or building their companies. And it's just the economies of scale. Let me handle or any other experienced operator handle the deal, handle the headache, and guarantee the debt. You focus on what you do best.
Yeah, those investors are really leveraging, your time your experience, your knowledge in the space, and I can see that being a tremendous, value to them, especially in the lens that we can always create more money, but we can't always create more time, right? So the time that you spend on your active real estate investment, might not yield the type of financial impact that you think it could, and it may be better off deploying that capital into somebody else's project where you're now leveraging their experience, their time, their track record, and their ability, ultimately to produce the types of returns that you're expecting, as an investor. So I'd like you to now maybe put yourself back into that first moment that you, as a passive investor, right, a limited partner investor, decided to make your first investment in the commercial real estate space. What were maybe some of those, big kind of lessons learned, coming out of that experience?
I did not properly leverage partnerships. I was using property management, but I was not leveraging um, other people's experience who had a track record in those. And so for my first foray, I didn't have the right brokers. I wasn't getting the right deal flow. And it was a really hard grind. The lenders didn't want to talk to me. I ended up partnering with a more experienced syndicator. And through that, this entire network opened up and our growth rapidly accelerated. So, I'm very, very thankful of that experience and that partnership because trying to break into these more of the commercial grade assets, it's very difficult to do. And it's really about who you know and having a relationship. I mean, for example, if you're looking at picking up an apartment, it's not just the price and the terms of your offer. You better believe those brokers are talking to each other and like, okay, look, your guy's put an offer. Can he transact here? Does he have the equity to close on this? Has he closed on multiple properties before? And they will actually steer the seller away from you if they don't think that they can get their commission paid. And so understanding how the partnerships work and how the different relationships work and the incentives and be able to be a known quantity that people want to bet on, that takes a lot of time and it's difficult to get in initially.
Yeah, it makes total sense. Real estate is a very heavy relationship type business, right? And so, your partnerships, your reputation, your network, all those things matter a great deal. And I would even argue, even as a passive investor, right? The types of maybe other fund managers or other sponsors, that you're aligned with, those relationships do matter. Okay, so important for people to, surround themselves with the right network, with trusted individuals that ultimately have their best interests in mind. So I appreciate that. I want to kind of pivot now and talk a little bit more about, capital raising. I know that's something that you do. What strategies or principles, have you found most effective when raising money from other investors?
I really like to work with potential investors who have their financial goals set out, and we can talk about how do our financial, like our investment offerings fit into that strategy, that plan, and that need that they have. A lot of my investors understand that we can get superior returns than the S&P 500. They want diversification away from that. And we really work hard to bring in these deals that we do have the meat on the bone to make sure that our investors get, excellent returns on that. I also like to focus on investors who are very motivated on the financial independence movement and trying to create that passive income. That's kind of where I started out with, and I saw real estate being such an accelerant to it that I like to be able to bring that type of asset class to those investors who are trying to buy back their time, open up their options, pursue maybe more philanthropic or creative career options, and don't want to be tied to that grind. So trying to find the investors in those places has been a real big focus for us because really one of our biggest competitors or challenges is just overcoming obscurity, right? We can't advertise with SEC regulations, so just trying to find people where they're at on their education and on their journey.
Yeah, that makes sense. What would you say is maybe two or three of the biggest motivating factors as to why an individual would want to deploy capital into a real estate deal or opportunity, from a passive investor perspective?
A cornerstone of that's going to be they want the returns, they want the cash flow. We're able to force appreciation of these assets, and you can't force appreciation on a stock, right? We also get very advantageous tax treatment. So a lot of our investors are looking to offset other passive income. We get all that depreciation that as you know, is a huge benefit to our investors in their tax planning.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Another question that I have for you is I know, we're really sitting right now in Q1 of 2025. Talk to us a little bit more about this book that you've got in progress, and how does it guide professionals to achieving, financial independence and really making work optional?
Yeah, I got a lot of feedback from the investors I've been working with. I on our consultation calls kind of talk about where they're at and provide some insights about my journey and how I got to where I am. And I got feedback from them that they want to go a little bit more in depth, and also it's, talking one to one is not very scalable. So I was encouraged to start putting some of my thoughts and journey, and with my finance background, some of the financial theory behind how drawing on your asset base works, and just having it be a bit of a jumping off point for people who want to pursue that financial independence, have that passive income to open their options up. So yeah, it's part of my own journey and my own story and my own hard lessons learned, and part how to and starting points and what to look for, how to begin that journey.
That's great. Well, I can definitely resonate with that. I am oftentimes asked to talk about my story into real estate, and kind of my, story about how I was able to achieve, financial independence, through real estate investing. But it's difficult to explain your journey to somebody in a 25-minute phone call, right? But if you're able to, encapsulate that into a book and publish and give people that option to read your story, definitely a lot more impactful. So I can certainly resonate with you there. I would like to talk a little bit now about kind of your, outlook for, 2025 and 2026. And I know that you're optimistic, and I hope that we all are. I think that's a good place to live. But why are you particularly optimistic about the real estate space, as we progress through 25 and 26, and how should investors prepare for potential upcoming opportunities?
I would start off by saying that 2025, in a nutshell, is looking to be a killer year for acquisitions. We're really excited, and the reason of that is that we've gone through both a large macro cycle and a smaller extreme cycle. So ever since the Great Recession, we saw asset prices drop, but since then, a lot of builders, a lot of people left the industry, the construction industry, and we've been underbuilding housing, both multifamily and single family, really for the last 15 years. And it's been interesting to me because I first dipped my toes in the early teens, in 2012, 2013. And even back then, people are like, asset prices started to recover a little bit, but people were talking about wait for the next bubble. This could be another crash. We can't, home prices are going up. And we've been sustaining that because of these systemic shortages and issues, unfortunately, for, a long time. And we've seen the resulting increases in prices on that. The more acute and macro cycle we went through was during COVID, and we had all of this PPP money, the ERTC, the tax credit for business owners, stimulus to every parents and people getting unemployment, and all this injection into money created a bit of a froth and a flurry. I mean, I was just getting into the capital raising side of things then, and the compression in cap rates and the jump in values we saw was extreme, and it was driven by tenants were flush with cash, and there was a shortage of housing. People wanted to leave their roommate and get their own housing, and so rents were growing quick, and it supported this asset price appreciation and a bit of speculation in there, coupled with a lot of business owners had a huge amount of government money that maybe they didn't need to keep their business afloat. Maybe it was thriving just fine in COVID. And so you had money chasing increasing rents. And that all stopped in 2023 as the Fed started raising rates, and the market just dried up. And I'm sure you experienced it too. We saw an 80% reduction in transaction volume. Our industry is in a full-blown depression. A lot of people that were managing existing assets have really struggled through that. And now we're starting to see a bit of things work through the system with the rate increase in cost of capital, you had to see prices go down and cap rates expand to justify an acquisition. Well, any of the sellers who weren't forced to transact and sell their assets haven't. And that's why we just saw that there was a gap in the bid-ask spread. And we're seeing that now the expectation is that interest rates are not going to drop down back to where they were, as the expectation was a couple of years ago. This is going to be kind of the new reality. And everyone who did have some distressed debt, who kicked the can down the road, needs to start facing the reality that they're not going to wait this out and refinance lower. So anyone who's coming in now, I mean, anyone who's been dealing with the hangover of that 2021, 2022 period, they're still going to be working through it. But anyone coming into new deals and new offerings are coming into a really great buying period. And I think that we'll see more transaction volume pick up at really, really good prices. And looking at the next 10 years, we're still going to have the same demographic tailwinds of household formation, immigration, and really a challenge of building new supply that's going to support good asset price growth. So I think it's a great time to get in.
Yeah, I couldn't agree with you more. I regularly tell folks that my 2023 and 2024 investments that I made in the multifamily space in particular are going to outperform the investments that I made in 2021 and 2022 for a lot of the same reasons, that you mentioned before. But I agree. I mean, we have a severe supply shortage in this country, both on the single family side as well as on the multifamily side. You couple that with the fact that most Americans have lost, 20% of their purchasing power in the last 4 or 5 years, due to inflation. And that's really why, prices have largely not gone down, as much as maybe they would, during another time in the past. So I saw 2021 and 22 really being very similar to the dot-com bubble burst days that I recall in the markets, back in the year 2000 and 2001. So it felt a lot like that in terms of what happened in the commercial real estate space. But the question then becomes is, well, what does the, savvy investor do today, right? Should the savvy investor be, doubling down, diversifying, buying, at a time where maybe prices are down across the board 20 to 30%, to kind of offset maybe, some of those investments that they made, at the peak of the market. So I'm with you 100% there. You have any additional color to share in that regard, Casey?
This is why diversification is so important. And part of diversification that gets overlooked is, the dollar cost averaging. If you're making investments over time, you're going to buy when prices are high, you're going to buy when prices are low, and you're going to diversify away from trying to time the market. The real estate market can move quick, but it moves much slower than, say, the S&P 500 that's very volatile. And so we can see that right now, this is a good buying time. And it takes time to do the acquisitions. It takes time to line up the deal, raise the money. So anybody who can see the writing on the wall, now's the time to get in and get with good operators, and you're going to have a strong tailwind.
Yeah, makes sense. I'd like you to talk a little bit to that new investor that's never passively invested in a real estate syndication before. Maybe they don't know anything about private equity. They don't know anything about syndication or that model. What would be maybe a couple of different pieces of advice, that you would give to that newbie investor that's not yet gotten to the point of, sending their wire transfer in to fund their investment?
That's a great one. And I've actually invested with other operators as well. I have a old IRA that I can't invest in my own deals. And so I've gone through and vetted a number of operators as well. The first I would say is consider maybe diversifying away from different operators as well. So you're spreading, not all your eggs in one basket. And the funny thing about when you're lining up a deal is you're creating a pro forma. If I have an investor who's like looking for a target IRR, not that I do this, but I can tweak my Excel sheet to like match 13% or 20% on the same deal, right? And you're tweaking a lot of different assumptions around rent growth, exit caps, saving operational expenses to boost NOI. So don't be shy about asking to see the pro forma. And the things that I like to see are, do we have low risk, stable debt? If you're looking to do a turnaround project in a couple of years with a 5-year hold, does the balloon payment of that debt align with your investment strategy? When we go in and we have a 5-year target for a refinance, we get a 10-year balloon or a 7-year balloon just to get that extra cushion on there. And then it would also make sure that if the rental assumption growth is 5%, then they're really trying to bank on that, the tailwinds, and they're trying to bake that into the model. I like to see 3% rent growth. And lastly is the exit cap rate. When you look at your period of selling, if you have an aggressive exit cap rate, which means that you think you're getting a lot of money for that NOI income stream, then you can really kind of juice up the returns you're expecting. So I like to see, let's stress test the exit cap, and does it seem reasonable? I think that those are pretty much the low hanging fruit of checking out. And you got to get a good feeling on the operators, right? I mean, those are the guys you're betting on. If you get a feeling that they're maybe not above board or they're in it for themselves, a lot of people try and get in this industry to get quick rich, and it's you got to build a reputation and a track record and have good feelings with your investors.
Yeah, I would like to double down on that effort if you don't mind, and I appreciate your perspective, on how investors can maybe dance around the underwriting model to maybe stress test the financials and come to the point and conclusion that maybe this investment team or operator has truly de-risked the deal for the potential investor. I would like to ask you, what are some questions that maybe investors can ask of the lead sponsor as they go through their personal due diligence? And I say that in one respect, and that is there's a lot of people that I trust in my life, Casey, but there's not a lot of people that I would trust with turning $100,000 investment into 200,000, over a 3 to 5 year hold period, if that makes sense.
Mm-hmm. Yeah. Well, there's the boring, nerdy financial stuff of, a pro forma is a collection of assumptions and forecasts. And some of the key assumptions, hey, what's the rationalization or justification behind why you chose this assumption or this expense or this growth? Sure. One thing that I'm surprised I don't get asked more often is, Casey, you're putting this deal together, you invest your own money. What keeps you up at night about this investment? What risks do you see as coming back to bite us? Is it interest rate risk? Is it the market's population growth or a big job employer leaving? What they'll operators should tell you, be frank about, hey, I think that this is a killer investment for this reason, but this might be what we trip up and what we're trying to manage to. And I'm surprised how infrequently I get asked that.
Yeah, that makes sense. What would you say in terms of the vertically integrated, operators, versus using, third-party management? I know me personally, for example, I prefer operators that are vertically integrated, on the property management, building construction, building maintenance side, because I feel as though that helps to, de-risk the opportunity, more so. And it also helps provide a more predictable outcome, for me as an investor. What are your thoughts on that?
I think that finding operators that are vertically integrated is hard to do, especially with a lot of new entrants coming in. So if you find one that is integrated, I think that's a really good strength. To be frank, it's something that we're working on as well. One of the big benefits is that when you look at how to make money in real estate, it's staying on budget, on time, and on occupancy. And the general contracting, vertical integration, and then owning your own property management team really facilitates that. If you're one client of a property management who has, dozens of other clients, you want them to be steering those applicants to your property. And if you own the PM company, then you can make sure that, you're focusing on your core interest, which is getting those tenants in. And then likewise with the GCs. One of the big concerns that we have is we just acquired a 102 unit property that we've got a lot of work to do on. It's actually like 50% occupied on one of the apartments. And so we're looking to acquire a GC company specifically because we want to control the crews and make sure that they're on our site, on our projects. And then, our GC doesn't win another contract across town that has higher margins. So he goes and prioritizes that, right? That's just going to, disrupt our deal too much. So I think it's a very good strength to have that.
Yeah, that makes sense. Casey, what would be maybe one or two different ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, I'm trying to be pretty active on LinkedIn, and you can just search Casey Stratton and I should pop up there. Our website is tamaracrei.com. And on there, you can sign up to be on our mailing list and kind of see what we're up to, what we're thinking about what's going on in the market. And we're always offering our new deals to that list first. So that's a great way to get connected with us. And then also that mailing list. When we launch the ebook, we'll be getting sent free copies of that as well.
Yeah, sounds good, Casey. Well, I really appreciate the value that you brought our listening audience today.
Thanks so much for having me. It's great talking to you, Jeremy.
Yeah, likewise. And listeners, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.